Kirtan, firstly, would like to know from you, how do you read the India outperformance? We had a lot of things at play, be it from inflation, interest rates hike. How did you read the India outperformance? And going forward in 2023, how do you see India outperformance continuing?
Hey, hi, Shrishti. Thank you so much for having me on the show. Shrishti, if you look at 2022 very specifically, I think there were a couple of reasons why we've been able to outperform the global markets. The first is if you look at the quantitative easing that happened globally, right? India and RBI specifically did a brilliant job, in my opinion, by not printing or opening the gates to liquidity to the Indian markets. I think because of that, what happened is that our inflation was quite in control versus how inflation reacted globally. So the first reason why, in my opinion, India really outperformed was because our quantitative easing was not as strong as the way it happened globally, and hence the larger impact on inflation that happened globally because of quantitative easing that didn't happen in India. And which is why I think our macros are far more stable than what we saw globally. Second, also is I think Shristi, because of what happened in Russia war, or probably what's happening in China so far, in terms of their zero COVID policy, and a lot of a lot of thrust on how the government there locally is managing this situation. A lot of this money that typically comes from the foreigner for the emerging markets actually stopped going to Russia and reduced their weights quite significantly in China, and which is why a lot of foreign money also came to India. I think these were largely two reasons why, in my opinion, India really stood out in 2022 while we speak about outperformance. Because we didn't print a lot of money, our inflation was under control, and hence our macros were very stable. And a lot of money that gets attracted towards emerging markets, flew less to China, almost zero to Russia, and a lot of that money got reallocated to India, and which is why we saw India perform so well. I think going forward in 2023, I think there are two things that we really need to keep in mind. For me, if everything else is kept constant or what it is today, I don't really see that inflation is really a big concern in India. Of course, there is definitely, in my opinion, going to be some pressure that is going to come on metals and oil, because China is opening up, and that demand part of inflation will kick in. But largely, that is going to have very little impact, at least in my opinion. So if you look at rates right now, though rates have moved up significantly globally, and so as well in India, I don't really think rates really have too much to go on the higher side from here on in India. So one thing is definitely rates have topped out, in my opinion. Inflation is not going to be a greater problem to India. Because of China, we might have some small bips here and there. But I think largely what has happened is because India has outperformed so much, right? And now that China is opening up, I think there is a distinct difference between the way the global markets or the global investors will want to look at India and China. India today, if I'm not wrong, is trading at 19 times forwards 1 year, and China is trading at 6. Right. So if you look at it from a foreign investor perspective, if everything else kept constant, I think China is a value buy, India is a growth story. I think in the near term, a lot of this money that actually came to India because it could not go to China will start repatriating back to China. So I think from an Indian context, I think we should expect higher end of single digits and not double digit kind of return in 2023.
Okay, so that's the outlook for Indian outperformance, but not just interest rates, Kirtan. We have been fighting with recessionary pressures in the global market. We are fearing that globally there could be a demand slowdown. What's your take on that, and how do you see India's outperformance? Because India can't be left alone when the globe is fighting with all of these major scenarios. So what is your sense that amongst this, although India is expected to outperform, which is the asset class that you should be at least wary of, or rather in the past, with all of these scenarios at play, which asset class hasn't performed really well in your sense?
So Shrishti, if I have to look at macros at this point in time, I think there is broadly only these two things that you look at, right? Whether inflation is going to go beyond control. I think, like I said, because of China, we might see a small immediate spurt in metal and oil, but I don't think that is largely going to impact inflation in a greater sense. In that context, if you look at rates, like I said, that I believe that rates have the 10-year has actually on the yield side topped out, in my opinion, in India. Of course, we might have a 25 bip rate hike in the next policy by RBI, but that contextually is not going to impact the 10-year too much, at least the way I look at it. So if you look at 2023, in my opinion, I think we should have some moderate expectation from India equity. If you look at fixed income, I think fixed income in my opinion, the longer side of the fixed income, which is the medium duration bonds or the long duration bonds, would really do well on the fixed income space, at least in my opinion. The reason why I say this is because interest rates, like I'm saying, or like the way I see, is topping out. And if you look at a 3-year perspective from now on, I think the 10-year in India is probably only going to fall from here on. Of course, it may move sideways for a quarter or so, but I'm expecting the 10-year to start falling, looking at a 12, 18-month horizon from today. And if interest rates are going to fall, probably largely the longer end of the curve, which is the medium duration funds and the long duration funds or bonds, will really do well, in my opinion. So that's where you should actually allocate spare capital for 12 to 24 months of investment horizon, in my opinion. And also highlighting, let's say if tomorrow the recessionary pressure builds on like we are seeing, or if all of us envisaging that it can end up happening in the US, UK, and Europe, this will only add to your long duration position on the fixed income side. Is because if recessionary pressure builds on, then there is hardly any scope for global macros to really build on the interest rate case, right? So interest rate probably will only fall from here on. So I think that's one place where I really see a lot of investment opportunity from a 12 to 24 month horizon, which is the long duration on the fixed income side. And also we've seen always and most of the times when interest rates start dropping, fixed income on the lower end of the curve, right? When interest rates will drop, fixed income typically will become slightly less attractive to the retail audience. And hence a lot of money starts flowing into gold. So I think some allocation to gold and some allocation to long duration bonds may really work out if probably recessionary fears that we are envisaging that has to hit the global economy actually comes true. And even if it does not, I think the long duration funds is a great bet at this point in time.
Much, Kirtan, for helping the viewers with your take that amidst all the global news flow that we have, which is definitely not on the positive side, where is India placed as per you and going forward, which is the preferred asset classes? And recently we have been discussing about this debt mutual fund. So earlier, a lot of experts out there used to tell that maybe a short-term duration bond is something that you should be looking out for, but they also seem to be changing stance. And thank you so much for highlighting your point as well. But with this, let's kickstart taking all your portfolio related queries, and we have the first caller also with us, JS Rao, there on the phone line. A very good evening, Mr. Rao. Tell us what you want to ask from our expert.
Yeah, good evening. And actually, I would like to know, I heard that some mutual funds are giving trigger facility.
Okay.
So I wanted to know, suppose some certain mutual fund has come to a certain value, I can switch from my debt fund to equity fund when NAV is a certain value.
Okay. Kirtan, you heard his question. I want me to repeat because he wants to know what is the triggering facility and he wants to make a switch as well. So what will be your advice on that?
So, Mr. Rao, I think it's a very interesting service or product offering that I would say that the mutual funds are offering. Typically, what a trigger facility is that it's an event that happens and this trigger will take place. So, let's say that event can be if the stock market falls 1%, right? Then the trigger will get activated and the money will automatically move from your liquid or fixed income fund to your equity fund. or probably, let's say you might also add in a trigger where, let's say if the NAV of the fund moves up 5%, you actually want to book profit and move that to fixed income. So that's largely what and how triggers actually work. And I think it's a brilliant facility, because if you see, most of us typically only theoretically keep saying that we will always keep buying the dip whenever the dip happens. But unfortunately, when the dip happens, most of us either wait for a bigger fall or really don't have the monies to invest at that point in time. And hence, I think trigger is a brilliant way to start allocating the money. If you think that markets are at higher valuation, wherein you can put a trigger, and for every 1%, 2%, 3% fall, depending on what you put as trigger, your money will automatically start moving from your fixed income to the equity fund that you've selected. So I think it's a brilliant option. And specifically at these market levels, you should definitely offer these trigger facilities that the MCs offer.
Okay, so that's the advice coming in for you, Mr. Rao. But let's move on, and we have some email queries with us as well. Kirtan, the next question is from Sandeep. He says that he has recently started investing in mutual funds. He has a couple of mutual funds in his portfolio. He has also shared the name, that is HDFC Mid Cap Fund, and the other one he has is SBI Small Cap. Will it be wise to add an index fund and flexi cap or a large cap fund to the portfolio? And if yes, please suggest some funds he is investing with a long-term horizon. So Kirtan, what will be your advice on this?
So I think for Sandeep, what Sandeep really has to understand is that it is futile to be able to predict which market cap is actually going to be able to outperform in the next 2-3 years. You look at the last 10-15 years of data and you will see that every year there is either a small cap or a large cap or a mid cap that actually has outperformed, right? So you look at the last 10 years and you would know there have been 4-5 years where small cap has outperformed, 2-3 years where mid cap has outperformed, and 2-3 years where large cap has outperformed. So if you have a long-term horizon, I think all of these funds at some point in time will really be the outperformer of the year. So my philosophy of building a portfolio has always been that if you really have the risk appetite and have slightly a long-term horizon, let's say 8-10 years, always try and add mid cap, small cap, large cap, all three to your portfolio. So now that you already have a mid cap and a small cap in your portfolio, I would suggest you to go ahead and add a flexi cap to your portfolio, which is a good pseudo replacement for large caps. Because largely all of these flexi cap funds in the mutual fund space typically are large cap funds. So add a flexi cap to your portfolio, Sandeep. I would suggest you to add a PPFA's flexi cap, because that will bring in not only the value style of investing, large cap focused investing, but also 20-30% of the portfolio is invested in global equities. So that will also bring a small global diversification also to your portfolio, along with market cap diversification.
Okay, so that's the advice for Sandeep. But Kirtan, let me take the last query for today. That question is coming from Kiran, and he's saying that he's a working professional and want to save 1 crore over the next 15 years. He wants some suggestion on a mix of equity and a debt fund. He has a low risk appetite and can invest up to 20,000 per month. So what will be your advice, and is this amount good enough to build a corpus of 1 crore in the next 15 years?
So Kiran, let me split this question of yours into two. First, of course, I understand that you have low risk appetite, but I think because you are going through the SIP mode, right, your volatility is as it is going to reduce. Also, your time horizon is good enough, which is 15 years, to be able to allocate some money to equity. Now, keeping both of these things in mind, I would suggest that even though you have a little low risk appetite, you can split your investment that you're looking at doing into 50% equity and 50% debt. Now, because there is 50% equity and 50% debt, I'm assuming that your portfolio will be able to generate roughly 10% returns. And at a 10% return, you will have to do a 25,000 rupee SIP a month to be able to reach 1 crore in 15 years. So first suggestion is you will have to slightly up your SIPs from 20,000 to 25,000. And while we are trying to do a combination of 50% equity and 50% debt, I would suggest you to split that into these 5 funds. So you do 5,000 rupees of Parak Parekh Flexi Cap, you do 5,000 rupees of Canara Robeco Flexi Cap. Now the idea is largely large cap investing, because you have little low end risk appetite. And on the fixed income side, I would like to suggest you to split the remaining 10,000 rupees into 3 funds. So you do Kotak short-term debt, 5,000 rupees every month. You do ICICI credit risk, 2,500 rupees every month, and do Nippon Nivesh Lakshya, 2,500 rupees every month. I think if you do these three funds on the fixed income side, I think you will have a good balance in short term, long term, and slightly credit. So I think that's my advice to you from a portfolio perspective of where should you really invest.
So that's the advice coming in for Kirtan. But Kirtan, we'll let you go on that. Thank you so much for joining us today on ET Now and helping with your take on how do you see the global markets and the news flow impacting India, as well as helping our viewers with their portfolio related queries. Great having you, and season's greeting to you.
Thanks so much for having me, Shristi.